Good morning, everyone. Thank you so much for joining us on this Monday morning. It's sunny and beautiful here in Vancouver as we're all staying around our houses for another day of work. Thanks for joining us. I'm keen to get going on today's webinar. It's obviously an exciting company. I'm joined here by Darwin Green of HighGold. And Darwin's going to take us through the HighGold story, which has obviously had a big news event last week with a resource estimate for the Johnson Tract property, and I know he's keen to tell us how that work went, why they made the decisions they did, and what the sort of platform it establishes for them going forward. But before I give him the stage, I am going to go through a little talk myself. So I'm going to start sharing my screen here and just go through a little talk about where I see the markets and where I think things are going from here. The bottom line is that I'm very bullish on gold. We obviously went through a huge turmoil in the last 2 months, but we've come out the other side of it in a really strong situation, in my opinion, at least. The bottom line for me, the reason that I'm so bullish is that I really do think that almost every force that you can have supporting gold is currently aligned behind the yellow metal, and that is what's making my position so strong. The most important pro gold force is always negative real rates, and we had them sort of borderline before COVID hit, and now we have truly negative real rates across major economies, and they are here to stay. Like, I mean, not for good. I certainly don't mean that we're forever going to be in a negative real rates environment, but in the next little while, it's very difficult to imagine, a major central bank raising rates in the near term here. And so we are in a confidently negative real rates environment, and that is very supportive of gold. In another big picture force, we obviously have a lot of money printing going on. We have unprecedented levels of money printing and buying across all kinds of markets from the Federal Reserve. That leaves tons of questions in its wake as to what the overall impacts will be of this unprecedented monetary effort. But one thing that is clear is that it's good for gold. All of the questions that start to swirl when a central bank makes moves of this type all lead back to gold as at least one answer. So that's good for gold. Then broadly speaking, of course, we just have a lot of uncertainty. Which way are the markets going to go? How is growth going to hurt in the second quarter? How quickly will it resume? What's going to go on with the virus? Will there be a second wave? Is all of this money printing going to lead to inflation? Are we looking at deflation? How impacted are global supply chains? There's a lot of uncertainty. Gold is, of course, sought in those times. Also on the side of gold right now is a big picture thing, which is that all through this stock bull market, investors have been taught over and over again to buy the dip. It's worked really well throughout this bull market. This time is different for sure. It's different just in that there was obviously this fundamental shift, which was the shutdown of the global economy. There's a lot of money that has been made in this bull market, and the reliability of buying the dip means there's a lot of money that wants to buy the dip. That is, of course, why the stocks have rebounded so much already. But gold has outperformed in that rebound and looks like it's set to continue. And the reason is that all of those forces are aligned behind gold. And there's a reliable pattern looking back through crashes that gold rises first. And so those investors who see a crash right now that's different, we don't know, there's lots of uncertainties around this crash, it's different, but they still want to position within it. The safe place to do that is in gold. And these charts show you just two examples of gold as the red line rising first out of crashes like in late 2018 and in the global financial crisis. Now, the other key force that I think is really important is that for many years, most generalist investment funds, big pools of money, basically haven't even looked for value. They've just bought the market, and it's worked really well. They haven't needed to do anything other than buy the market. That's been powered or supported by the fact that, funds are all about benchmarking. All you have to do is outperform the benchmark a little. So the best thing to do is mostly just own the benchmark and then have one or two trades that perform better and you win. That's what funds have been doing. They haven't had to look for value. But now they do. When something dramatic happens, investors either expect a fund manager to have foreseen it or to profit from it. They can't just ride the wave. And so they are being forced to look for value. As fund managers look across equities to try and find value, gold miners stand out amongst everything else. They have gone through years of cost cutting and fiscal prudence. They have a very strong gold price backing them, and put those together, and they have the best earnings and balance sheets around. Like literally of almost all companies, gold miners are in an incredibly strong position. And so that really matters when a fund manager doesn't have to be a so-called gold bull. They don't have to see 3,000 gold down the road, $3,000 gold ahead. They just have to be looking for fundamental strength and undervaluation. And that is what gold miners offer, along with all of these other forces being aligned in our favor. And this is all already happening. So for a few years now, I've been talking about we need the generalists to show up. And they haven't shown up because fund managers have been buying the market. We needed a change. We got the change in the form of a shocking global pandemic. But that change has prompted this search for value, and generalists are now rotating towards gold. There's multiple anecdotes around that support that statement. One that I like, that I've been sharing in the last week, is chatting with a friend who's in Fidelity, and the head of Fidelity has the largest mutual fund in the world. They manage $150 billion in the Contra Fund. And the head of Fidelity talked to the managers of that fund and was extremely bullish on gold. Now, just imagine if those fund managers allocate some small percentage of $150 billion to gold as a result of that conversation. That is an immense inflow of capital into our little tiny gold sector. That is happening. That is why Newmont's share price is doing what it's doing. Barrick's share price is doing what it's doing. The majors are just killing it out there. It's because the generalists are here. Now, what's important to note is that this inflow will continue for some time. This isn't an overnight event. You didn't miss it if you weren't already positioned. It takes time for this scale of money to invest, so it is still coming in. And just as importantly, there's this idea that I call the gold market builds its own momentum. So obviously, as you get more inflows, the gold market continues to rise. That attracts more to the space, and the gold market builds momentum. We are just at the beginning of this, and gold markets are reliable for how long this kind of momentum lasts and how high it can propel the market. That is certainly aided by the fact that the market is just so small. So when a few percent of $150 billion tries to find a home, there's not that many stocks that it can buy into. And so Newmont gets pushed through the roof, Barrick gets pushed through the roof, and the money then starts to move down. If this is happening, the key question for all of us as investors is, how should we play? As I just said, majors are well up, but I truly believe they will keep rising. Big money, like these big funds, they require big liquidity, big market caps, defined metrics. And so there's not that many stocks that these large funds can buy into. They will continue to buy the major miners and the major royalty companies, and those will continue to rise. Focused gold investors are clearly already buying the next tier down. So I have Marathon Gold here as an example. As a developer, an advanced asset, these are the kinds of projects that offer clear, defined value growth during this bull market, right? So value growth that you can count on paper because they're advanced assets. There's also a group in there that that in addition or just offer optionality. They just have a lot of ounces in the ground, and as the gold price rises, those ounces get a larger valuation. And so money is moving down into the second tier of developers and advanced assets. And of course, layered on top for all of the ones in that, all of the stocks in that category, is the potential for deals to happen. Certainly, this could be a topic of its own webinar, but there's a clear need for majors to acquire more development assets. Their pipelines are not terrible, but they're certainly not strong. And they now have all this cash coming in from a really strong gold price, so they are certainly likely to be buying in the next little while. And so the potential for deals helps share prices rise as well. I want to comment for a moment on optionality. I have Northern Dynasty here. Note that this is the Northern Dynasty share price chart from 2003 to 2012. So this is an example of what optionality, what a large resource can do in a bull market. And so Northern Dynasty went from, I don't know, 75 cents to $20. Certainly in that time frame, the company grew the resource. But almost more important, I would say, is that the value per ounce in the ground that a market gives to a deposit, just that ratio keeps rising as a bull market grows. And so big ounce counts work better and better and better in a rising gold market. And so that's why you get the kind of leverage that you get from a group like Northern Dynasty. And I'm noting this right now because I do think optionality plays offer a particularly interesting opportunity right now. If you look at assets that aren't really yet economic, their grades are a little bit low for the market to care about them yet. Those assets will become have to play catch up, and then get that value per ounce in the ground leverage going forward. So I think that's an interesting category to pay attention to at this juncture in the market. On the exploration front, if you're listening to this call, you're obviously interested in high gold, so you're clearly playing the exploration front. My comment here, I mean, I have a few, obviously, but I would note that you want to be careful to focus on companies that can be active in the COVID world. And so COVID is making exploration hard. It's making it more expensive. It's making it less efficient. And in some jurisdictions, it's actually making it impossible. And this, you have to be quite careful. You really have to talk to management. You have to get an understanding of whether they truly think they're going to be able to operate in this coming exploration season. Because, so if they can't, that's obviously a downside. If they can operate, that's an upside, because I do think that the COVID restrictions on exploration mean that we're going to have a bit of a shortage of exploration news, just as investors are really starting to pay attention to exploration news. They're hungry for it, and we're actually going to have a little bit of a shortage of it. So I do think it's important to find if you can find companies that are able and ready to drill strong targets now or in the next little while, and therefore are likely to put out exciting exploration results into this market that's hungry for exactly that kind of thing. Those companies are set up to catch an opportunity that others will miss because COVID is making life difficult. Generally speaking, investors are still gravitating first to lower risk jurisdictions, new and exciting discoveries, and simple deposits. Attention will trickle down later in the market to higher risk jurisdictions, older assets that are growing, more complicated deposits. But for now, keep it simple. Focus on the ones that stand out on their own because they're clear and easy. I would note that dollars are definitely available. So if you're considering a company, but the management team is having difficulty raising capital right now, that I would consider a red flag, because capital is available. Speaking of capital, good explorers that need money to not miss this exploration season so that they can feed exploration results into this hungry market are doing financings now. So if you play the financing side of things, then pay attention, because there are some interesting opportunities happening, and a lot of them sort of open and shut very quickly. Financing gets announced and then almost the next day it's closed, because there's a lot of people who are interested in getting in at these levels. And I would say for years, since this market turned at the beginning of 2016, I truly only considered the very best of the best. Because I'm so bullish on this market now, I really want to make the most of it. And that means that I'm also considering the best of the rest. So you might want to broaden your exposure a bit, because I do think that we're going to get a rising tide impact here that is going to lift all ships. And yeah, the more ships you have, then the more lift you get. I didn't want to spend a lot of time on the broad outlook now. I've certainly given lots of talks and webinars. Perhaps you've seen them, perhaps you haven't, but I have been going on and on about these markets for the last little while. I'm certainly keen to transition over here to Darwin and see if we can have a little conversation before he kicks off talking about HighGold and what they've been doing at Johnson Tract. So Darwin, I was talking a lot about generalists showing up and the interest and what they're buying and whatnot. I think it's kind of interesting. HighGold's a bit of a unique stock in that you are sort of brand new and yet also advanced. And so I feel like you may be attracting sort of an interesting hybrid of interest from investors, from retail all the way through to funds. Do you want to talk to me about who owns the stock? Who's been calling you is interested in the stock? Yeah, just take us through that, because I think it's an interesting insight into the company.
Yeah, well, thanks, and thank you, Gwen, for having me on. So I guess in terms of who owns the stock right now, it's a real mix of sort of retail, sort of recognized mining figures like Rob McEwen, senior gold producer, and some blue chip institutions. So it's a really nice broad spectrum there that we already had. In terms, I think, going forward, I think you hit the nail on the head. We are in this hybrid space, which I think makes us more appealing to some. When the generalists come in, as you described in your presentation, there's sort of a tiering down. There's the Barricks, the Newmonts that are getting the first dollars coming in, and then the next tier down, and then the developers. And we kind of straddle that. We've got a resource, so we're backstopped by ounces in the ground, but we still are fundamentally an exploration story and have that excitement that comes with the exploration. So we kind of get the best of both. And I think as more money comes in, the fund managers are going to be looking to have some exposure to that. And we would like to think that we're certainly a story that would be on that radar screen, or within that sort of upper list.
For sure. And then I also talked about, for those who are doing exploration, whether they're going to be able to operate this year. So do you want to also just comment on Alaska and COVID and what your outlooks are for operating? Those questions may not all be answered yet, but what do you know at this point?
Yeah, for sure. I mean, we've been looking at it very hard for a while now. Alaska is a place that resource development is really important to the state's economy. And there's recent announcements from the governor up there stating that. So the mining industry is considered an essential industry, and there are actually active exploration programs going on right now. Not a lot, but there are some actually active right now. There was an initial shutdown that happened as they did sort of a shut-in notice across the state. And then I think it comes down to the specifics of a given project and its location. So in a place like Alaska, where you have a lot of remote villages that don't have the health support systems that a lot of other areas do, there's an extra level of sensitivity, and requirement really of companies to ensure that they're not going to have a negative impact if there is a COVID case that it spreads in those areas. We're fortunate to be in a pretty isolated spot where our travel to and from the project is out of Anchorage, and we've got a camp that's sort of standalone. So for a few of those reasons, we feel pretty comfortable in terms of being able to operate. That said, we did defer things a bit. We delayed them by about a month. We were originally planning to start in June, and we just thought it was prudent to take the time to get everything in place so that we can operate in a safe way. But we're pretty confident we can get going.
All right. Well, I'm sure everyone is keen to hear what getting going looks like. I know I'm sure there's two thrusts to your presentation here, talking about what you figured out and defined as a resource just last week, and then where you're going to go from here. So I'm going to kick the controls over to you, and I'd love to see your presentation. Oh, and also anybody who's watching, certainly if you have questions, please enter them in through the webinar portal. I see those questions come up, and after Darwin has done his presentation, then I will convey those questions through to Darwin so that we can follow up on everything. So please ask questions if you have them.
So do you see my presentation up right now?
Yes.
Okay, good. It's a good start. All right. Let's see if I can minimize you a little bit. Don't take it personally. All right. Well, thanks, Gwen, and thanks again, everyone, for tuning in. This presentation, it's 10 minutes or thereabouts, and real quick, recap of the company on a corporate level. Then jump into the resource because it's brand new, and we want to talk about it a little bit, and then where we're going next in terms of exploration. So we'll be making forward-looking statements. Just a quick I don't know, checklist, if you will, that I look at when investing in companies. And really this is listed in my view in kind of increasing importance, you know, from share structure to who's in the deal. Do you have cash to be able to execute? Management's obviously very important. And it's got to include both a real strength in the technical aspect as well as in the financial circles. And we believe we have both. And what you're looking for, it's got to be a desirable top tier type of asset. You know, obviously in the exploration phase, you don't know you have one until you're further down the road, but you got to be looking for the right type of asset. And then with everything, you got to see some value to the upside. You got to be investing. So quick snapshot of the capitalization structure. We've got 40.2 million shares outstanding right now, so pretty tight. We got a market cap. All these numbers in here are as of last Friday, actually the previous Friday, sorry, April 24th. So market cap about 45 million, 11 million Canadian cash, no debt, and the shareholder roster you see here. We think it's a perfect mix and a great endorsement of what we're doing. I would like to point out here too, we do have 8.5 million warrants priced at 70 cents, so those are in the money. They expire in September 2021, so there's opportunity for a no-fee financing tied in there. We can bring some of those down. So we're new. We formed in, we listed in September 2019. We called ourselves HighGold because we're focused on high-grade gold in North America. Johnson Tract is our lead asset, our flagship. That said, we've got a very nice portfolio of projects in the Greater Timmins Camp, Ontario. This presentation is going to focus, given the time constraints, just on Johnson, but it is a nice duality in terms of being able to be active year-round and both very attractive jurisdictions to be operating. So here is just a location map. We are in South Central Alaska. We're kind of on the west side, Cook Inlet. It's you know, access is everything, and being this close to tidewater is huge for a project like this that, if successful, would produce a base metal concentrate. Community's close at hand to be able to support the operation, but you know, we're not really bearing down on anyone in particular. So as a kind of a high level overview, shown here on top, we just came out with this resource. We announced it after markets Wednesday last week. So 750,000 ounces gold equivalent at a 10.9 gram per ton gold equivalent grade. That's in the indicated category. Then an additional 134,000 ounces gold equivalent at a grade of 7.2 grams per ton gold equivalent inferred. We view this as a great start to the project. It's nice to be able to quantify what we have, and I'll provide some more detail on that. But really, this is just the starting point for us. This is a project that's been dormant for 25 years, and it's only now seeing its first modern exploration. And there's just tremendous exploration upside and opportunity, and I'll get into that at the back end of this presentation. There's been some question as to what the deposit is. It has been likened to VMS type deposits like Eskay Creek historically. We see it more like a Hod Maden, which is a really attractive deposit in Turkey. Sandstorm owns 30% of it. We make a comparison to it not only because of its grade profile, but its geometry, its dimensions are all very similar. It's one of these very rare systems that has both grade and exceptional width, and ultimately that translates to very attractive economics. It's, you know, 3 or 4 times larger than what we have defined now, but it is the prize, and it's one of these few deposits that has a better than 1 billion net present value, and also has a better than 50% internal rate of return. There's very few projects out there like that. It's because of margin, and that's really comes down to the geometry and grade of your deposit. So let's talk about that resource. These are the key points we like to highlight. Grade, you know, it is very high grade. It's in the top 10% of undeveloped gold deposits out there in North America. We have a high degree of confidence in the resource, not just both geologically, but in the fact that we have 85% of the total gold equivalent ounces in the indicated category. And then the rest of these highlights are really features that emphasize sort of the attractive engineering attributes, or which ultimately translate to lower cost mining, or and that's, I'll talk through those here in a minute. So this is just this resource statement. It's done at a 4 gram per ton gold equivalent cutoff. So 2.1 million tons at 10.9 grams gold equivalent. It is a polymetallic deposit. It's convenient to report as gold equivalent. As it stands, there's about 56% of that indicated resource is gold proper. The remaining 44% is split between the other metals. We do know that there's good metallurgy on this, so we're comfortable reporting it in this way. So in addition to that, almost 600,000 tons at 7 grams gold equivalent. That's what we have defined right now. This here kind of gives you an idea of what makes it up. So when I talk about confidence in the deposit, in the geology, it has, that starts with drill density. So what we've seen is really good predictability of the deposit. We've got very good drill density from top to bottom and good spacing of that drilling that demonstrates excellent continuity from top to bottom of good grade mineralization. That's allowed us to get so much of this resource into that higher confidence category, the indicated category. Having a look at what that looks like in terms of a block model, this is more or less the same view. This is how you generate the resource estimate. What this does is gives you that feel for the dimensions of this, and for lack of a better word, this is a fat deposit with this excellent continuity of grade. You can see all of that resource sticks together as one big blob, if you will, with dimensions extending about 275 meters vertically, about 300 meters horizontally, and a sort of a long strike that is, and then a true thickness or horizontal thickness anywhere from 20 to 50 plus meters on average. So a really, really nice looking slug of mineralization here. Taking that further, here's a cross section and a level plan that just help demonstrate that continuity of that good width of good grade mineralization. And so what you have here, which is you've got the kind of grade that you normally associate with a narrow underground mine, except we've got the widths that you would typically associate with a bulk tonnage underground mine, or even a bulk tonnage open pit mine. Here likely would be underground. We're not going down that path yet of starting to think about mining because we want to keep exploring it. But what we do know is we've got the best of both worlds right now with what we do have. It's grade, width equals margin equals very desirable. So switching gears here a bit, to talk a bit about where we can take this, where we're going next. This is just a chart of gold price from the early 70s until today. Superimposed on that is the periods of activity on the project. So CIRI, the native corporation that owns the lands, they were conveyed the lands in late 70s in 1979. It was then optioned to a company called Anaconda Mining, who were one of the bigger mining houses at the time, and they made the discovery hole in 1982. They ultimately got out of the mining business, and it passed hands to Westman Resources, who were operating the Premier Mill down around Stewart, British Columbia. It's now an asset owned by Ascot. So what they were looking at was actually direct shipping the ore from here to Stewart. It was meaning mining, taking that ore, not milling it, but trucking it to the coast, putting it on a barge, taking it 900 miles down the coast, putting it on another truck, taking it up to the Premier Mill and processing it. At the time, Westman was pretty hand to mouth there. They were in need of more ore feed. They had a very hungry mill. They ultimately shut down that mine, and this project reverted back to CIRI, and then nothing happened. Nothing happened at all until CIRI approached us, and we signed a mineral lease with them, and that was finally executed, the final lease in early 2019, and was the catalyst for the formation of the company. So it's really missed 2 or 3 major gold cycles, and then the last guys that worked it were so focused on the engineering, they didn't really give the exploration the attention that it needed, and that's where we come in, and that's why we're so excited about the opportunity ahead of us of being able to grow this deposit. So shown here is a cross section of the mineralization. You can see it tracks from surface all the way down, and then it abruptly stops, and it stops against a fault. It's called the dacite fault. It's a post-mineral structure that essentially offsets the deposit. So we fully expect this deposit would keep going, but it's been a fault's come along and moved it after the fact. And some of the best grades and widths were actually right up against that deepest part of the fault. So we should in theory, see similar type mineralization on the other side of it, as long as you can find it. So this here, slide 15, is sort of a simplified model to demonstrate that. So the JT deposit on the left is what has been defined, and there's still some room to grow that on that side. You know, we've got some drill targets that we do intend to expand and grow it, but the real, I guess, transformational change will be if we can keep chasing this deposit at depth on the other side of the fault. So the past workers had worked out this offset, they knew it had moved along, but they just didn't know how far, so they proceeded to drill their way along, and they finally picked it up near the end of their cycle there. It was, there's 3 or 4 holes that are down below that fault. They're spaced very wide apart, far enough apart that you could actually miss the entire JT deposit between them, but they picked up the exact same style of mineralization and alteration, which is important because there's very, very distinct alteration around the JT deposit. It's this weird anhydrite alteration that's cored by silicification, and within that is the high-grade core of gold and other metals. And so what they were able to do, and it's very rare to find, it's only associated with the deposit. So that drilling has picked up that exact same sequence with gold, and it's waiting there for us to start drilling. So that's our prime target as soon as we get back on the ground, but by no means is it the only target. So this here is a plan view map. It highlights the 5 highest priority targets that we intend to drill this season. Number 1 on this figure is that offset target, and so you can see that fault cutting across on a diagonal line. Well, originally that where that 1 is used to be back down by the number 3, and that orange outline is the alteration of the system. It's about 2 kilometers in length, north-south. Past workers were very focused on only targeting a very narrow band where they drilled that was parallel to stratigraphy. So what that means is we've got, you know, 5 to 10% of that total alteration system has seen any drilling. And we think there's a very compelling argument for this deposit to have a more north-south trend than a sort of a northeast-southwest trend, which they were drilling in the past. So target number 1, target number 2, target number 3 is just an expansion of the resource itself. Target number 4 is actually following up of a brand new discovery we made last season when we drilled our first holes into this. We pushed a couple of holes deep. One of them hit a brand new vein zone, 20 meters at 2.5% copper and 5 zinc. Less gold, but still very high value rock. It didn't make it into our resource because we only had the 1 hole, but it's an exciting one that's open for follow-up. So, you know, lastly, I guess I highlighted various features on the intro to this. The last one was value, and we do think there is a compelling value story for HighGold. These are all great stories on this slide here, so don't take a red X as being a negative for these guys. I'm just saying if you can check every other box, it's more of a positive. So one of the features you see for all these guys, they're all projects that are in first world stable jurisdictions, great mining jurisdictions, and they command a premium. So whether it's Finland, Quebec, Yukon, Ontario, or Alaska, these are places that are the most desirable places to find and build and develop a mine. Then if you go through the rest of the check boxes there, we've generated some of the very best drill results out there for 2019. There's lots of good results that these guys have generated, but we think ours stand up equally as well. We've got the money to go execute and complete our program. And you can see here that we're about, our market cap right now is about half of the median value of this peer group. So I guess that pretty much wraps it up. You know, we've got a healthy resource. It's a maiden 43-101 resource for this project. That's a good backstop to the valuation for the company. What it's been able to characterize is a really, really attractive style of mineralization, and we're very much focused on finding more, looking ahead to find more. And we don't think you could ask for a much better opportunity after sitting dormant for 25 years and the quality of the targets we have to get after them. So with that, I guess I'll hand it back to you, Gwen. Do you want me to hand over the presentation? Or just...
Yeah, why don't you keep your slides up? We'll do some questions now, and it might be useful to be able to flip around in the slides while we ask questions. So again, there are definitely questions coming in, but if you have a question, please enter it and send it over to me, and I can convey it now as we go through this Q&A. So let's just dive into the resource for a second here. There's been a few questions around there's always lots of decisions when you make when you calculate a resource. I mean, you have to do all kinds of cutoffs, and you have to make you know, you spoke to the decision to report in gold equivalents. Do you want to talk about your approach to this resource. You know, you could being conservative on your parameters versus, you know, giving the market what it wants. Do you want to just sort of, I think it's an interesting discussion as a whole too, because there's a lot of decisions that go into a resource. It's not just a number that a model spits out.
For sure, for sure. And I think one thing that, you know, some of the audience may not appreciate is certainly all resources aren't created equal. You know, and your comfort level in terms of what you use to define the different parameters is based on a variety of factors. And for me, it always starts with geology. And we've got an exceptional geological team. We've been blessed as a company to have this, you know, team that we've been able to develop over the years that have migrated over to HighGold. And we've spent, you know, a year and a half kind of understanding the geology. So before you even start, you want a really, really good geological model. And, you know, one area, for example, where you see differences in resource estimates is how far do they push out the outer boundary of the geological solid from the drill holes to say, how much are we going to grab and include in this resource? Well, in our case, we didn't go any more than 25 meters outboard of the drill holes in terms of defining the geological solid. So it's very tightly constrained that way. You know, oftentimes you see people go 50 or 100 meters or more. So that's one element, and it was definitely driven by geology. And then once you have that geological model, you let the resource block model populate inside of it. Next would be, say, the search parameters that you use, or the cutoff grades. You know, the capping level. You know, we had really good, well-behaved, I guess, assay values that allowed us to choose a cutoff value that was based on a fairly conservative approach based on the distribution of those outlier assays. And then when you start to see outliers, you cap them. Then when it comes to, say, the indicated, you know, what made our indicated category? Well, a block within our resource model had to be within 20 meters of a drill hole. And not only that, it had to have 3 other holes within 35-meter radius around it. And you had to have at least 1 hole and 3 different octants in a sphere around it. So it's pretty tightly constrained body of mineralization. Yeah, and then after that, you know, cutoff at 4 gram per ton cutoff. I think if you look around, you know, we applied maybe a more conservative factor because it is Alaska, and I think people view Alaska that way. And it's a base metal gold equivalent thing, so we thought let's be a little bit more conservative there. But by example, Maiden, which is a polymetallic deposit that has the same sort of geometries as ours, it's larger, but the overall geometries and mine methods would be similar. They're using a 2.6 gram per ton gold equivalent cutoff.
Gotcha. Yeah, I mean, great answer in terms of the project itself. And also, like I say, I think it's always, I find it, maybe I'm just a geek, but I find it interesting to dive in a little bit to how these resources are calculated. That, like I say, it's not just like a computer spitting out a model. There's a lot of decisions and a lot of factors that come into play. Okay, let's talk about this system a little bit. There's one question, sort of like, how deep can a system like this go? Obviously, it's an unusual geology, so there's not an obvious answer to that question, but that clearly relates to the offset target, which is going to be your key exploration focus coming forward here, and what scale it might have.
Yeah, no, that's a good question. You know, I think especially if you start thinking it's maybe more of the epithermal than a different type of deposit, it opens up. Sometimes epithermal systems will have a, you know, a vertical zone where their mineralization likes to sit. What we have seen here, while there is some zonation within the system, we've seen fairly consistent and good high-grade gold from top to bottom, really with some of the best grades so far down deep. So from a, you know, geological model, metal zonation perspective, we don't see anything that should limit it right now. So definitely there's room for that, taking it deeper. But I think it is important for you know, for people to understand it's not just finding that offset and taking it deeper. We think there's a compelling case that you may find a string of these in a north-south pattern based on the alteration we're seeing in the overall style. There may be certain geologic units where it blows out more just due to their primary permeability of those units. But we think there's really good reason to find more along the sort of north-south strike as well.
Okay, so that actually leads nicely into the next question. I've had a couple questions about what your exploration plan is this summer, how large it is, number of holes, meters, what targets you're going to look at. And I know you and I have chatted recently about the decisions that you've had to make around that, because you have, like you say, not just this offset target to pursue. You have quite a few targets, and they're sort of over a reasonably scaled land package. So there's decisions to be made about what to do.
Yeah, so I guess there's a couple ways of looking at it here too. So what I showed on the slides is really just the stuff that's within like a 1 kilometer radius of the main deposit, and we have an abundance of compelling targets right there. That is going to be our primary focus as we come out of the gates. But it's worth reminding people that this is part of a project that has a 12-kilometer trend of other showings, and you can kind of fly the length of that and see alteration zones where you can get good geochemistry at surface. We got a very limited program in September, got some feet on the ground to just get a bit of a feel last fall, and with most of that work being at a prospect called Difficult Creek. It's 4 or 5 kilometers to the northeast. It has an old 1982, 1983 vintage drill hole that reports, 3.5 grams over 35 meters or thereabouts with base metal. It has the same identical anhydrite and silicification alteration. We got in there and found a brand new vein about 400 meters away. So there's tons there to go looking at. But our focus right now is going to be from a drilling standpoint. We have more than enough to keep us busy in that radius of the deposit. But while that's going on, we will be out doing geophysics and mapping and tee up those other properties so we can be as, I guess, efficient as possible with our drilling when we finally get to them.
And then for the drilling that you are going to do in the JT target area, you're going to have 1 rig, 2 rigs? Do you have an idea how many holes or meters? There's a couple people who've asked about that. Yeah,
for sure. So, we're tentatively looking right now at sort of somewhere in the 7,000 to 10,000 meters as a starting point. We've got the budget to do that, certainly 7,000 meters plus, and I would say that's somewhere in the order of 25 holes or more as a starting point. And so one of the things I think as a management team, we want to get after this project as aggressively as we can. We can drill it from May to late October, and we're already starting a little bit later in July. That said, there's a huge amount of room on the back end if we're having success to expand this. But as a management team, we're going to take a prudent course here where we're being quite aggressive, and we've been given money to go out there and drill and expand this, but we also want to be a little bit sensitive to the market. So if the market's in a place where the wrecking ball comes back and there's a zero reward for results, you don't want to spend your entire treasury. But we are in a position where we can be very aggressive with 2 drill rigs, hitting it hard, get us through to sort of mid-late August, and if the momentum's there, we can keep pouring it on and drilling more.
Okay. Let's talk about 2 more technical sides of things. So why are you comfortable with the metallurgy in the deposit? It seems somewhat complicated and certainly polymetallic. So what gives you metallurgical confidence?
Yeah, so one of the, I guess, attractive features of this project is because there was so much engineering work done historically, it's de-risked it more than it would normally be at this stage, in that the Anaconda did metallurgical test work and Westman did metallurgical test work, and admittedly there's still going to be more to be done, but it really has kind of shown there's no red flags in there. They're projecting good recoveries, sort of 90% plus for gold and 80 to 90% for the base metals, based on the work they had done. And it's really coarse grain mineralogy, and the geochemistry from all of our assays is really low in the traditional toxic elements or penalty elements. So from what we see right now, the work that has been done has shown it to be good. Sometimes in these, particularly polymetallic, gold in particular, you can have a real tough time getting the gold out if it all ends up in the zinc or somewhere else. Here, everything's suggesting, they were, Westman, it was a sort of an internal PFS. I probably wouldn't quite meet modern 43-101 reporting standards today, but it was that level of work they were doing to assess the development of it. They were forecasting 96% as the gold recovery.
Gotcha. Okay. Then there's permitting questions. So certainly let's talk about how is it that you have the right to explore in Alaska in what appears to be parkland?
Yeah, good question.
It's a valid question.
I'm glad you asked the question, because it's important to really understand the history here. And it's a little bit of a longer answer than you may like, but I think it's important to provide the background. And first and foremost, Alaska is in a very unique situation because it resolved its native land claims issues in the 70s. It was through a big federal act, ANCSA, and it created these 12 regional native corporations. And it's a very unique model. I don't think I've seen it anywhere else, but it created these 12 regions and then there were corporate entities with the shareholders being the native peoples within those regions that are, they're the shareholders of those corporate entities, and they were then given lands, and these lands were selected for their mineral potential. So from a sustainability standpoint, it's a very attractive scenario where the benefits from mining here will go directly to the local indigenous people in the region. And it's got an actual really neat clause in it. It's called the 7I clause, whereby more than that, they actually share that amongst the resource revenue amongst the other 12 regional native corporations, and then that money gets tiered down to village corporations. So it's really quite cool. So anyhow, that's the history of the land selection. The park was actually formed after and semi-concurrently with Ceres land selection. So Ceres stands for Cook Inlet Region Inc., the native corp that we have the lease with. And their group ended up giving up a large land selection to allow the formation of that park. So it's written kind of into law that there's an easement, a road easement and port easement, and an ability to mine here. So it's a bit different. And those that know Alaska, if you look at the projects that have been successful, in terms of permitting path timelines, ones in which the native corps are partners, whether it's Red Dog or Donlin or Trilogy, the Arctic deposit, are ones that have generally had a much smoother path.
Right. Yep, it's an important question for sure, with a complicated but thorough answer. Someone was asking about what you know about the geology of the Footwall zone. I know you only got one hole into it, so what do you understand about that new zone, and what might it tell you about mineralization more broadly?
Yeah, well, one of the things we did notice, it is different in character in that it's sort of a chunky vein swarm. We've got veins from 30 centimeters to 2 meters wide, that kind of, with heavy base metals in those veins. It doesn't appear to have the anhydrites and silicification surrounding it. Maybe a little bit of silicification, but it's not the same kind of concentrically zoned alteration mineralized system that we see at the Johnson deposit proper. It's very close to it, but it is offset and in the footwall. It appears like it may have a north-south trend. We didn't do oriented core, but the core bedding angles and based on all the little micro features we see elsewhere suggests it may have a north-south trend. So that's what we know right now. It looks like some sort of vein system. We don't know how it's directly related, but it's undoubtedly part of the overall mineralizing system.
Okay, let's talk about, there's actually been a few questions, I shouldn't say actually, there's been a few questions about you. Who are you? What's your background? Explain yourself.
All right. Well, I'm a technical guy. I
think that's apparent, Darwin.
Yes, sorry. Maybe too technical.
No.
Yeah, I did my undergrad at UBC, master's at Carleton in economic geology, and worked with various juniors and a couple of seniors. But really, the big foundational part of my career has been the last 15 years in Alaska. It's a jurisdiction I know extremely well. I was VP of exploration for a company called Niblack, where we permitted and put in underground development there. I was VP of exploration prior to this current gig with Constantine. As you know, and some of your subscribers may know, HighGold was spun out of Constantine. And it was really there, the last 5 years while I was there that I cut my teeth in terms of the financial markets and marketing and that sort of thing. So I like to think I bring a nice blend of both. But I'd like to talk a minute about the greater team here. We've got a fantastic team. My VP exploration, Ian Cunningham Dunlop, has got a tremendous history in Archean Gold and Eskay Creek and around the world. He was, a VPX for Frontier. That was Mark O'Day's company that was taken over by Newmont for $2+ billion. A real fantastic guy. And then, the rest of our core geology team is really strong as well. And then Naomi Nemeth, our VP IR, has got a lot of experience, with a lot of successful companies.
Okay, what was the last one I was going to ask you here? Right, we haven't talked about Ontario. So actually the next results that will come out from HighGold are from a drill program that was a little bit truncated because of COVID, but from your other projects in Ontario. So, you know, in not too long an answer, what did you do? When do you expect those results to come out? And actually, it turns out your backstory sort of starts, just to tie it into the last question, you have a lot of comfortability with high grade red lake gold in Ontario as well. So this question ties into that as well.
Yeah, no, that's right. Yeah, I spent quite a number of years in Red Lake, and some work in Timmins as well. So yeah, we got about half of what our planned drilling. We drilled about 2,500 meters of a 5,000 meter program. We kind of made a very early decision to shut things down in an orderly way, which worked out well. We completed the drilling on one of our 3 projects. We were going to drill all 3. We got all of the drilling done on one, 0 drilling done on another, and then about a third of the drilling planned on Croesus. So those results should be out fairly soon. You know, it was a great first kind of introduction to some of those properties and get some drilling there. It was unfortunate we had to shut it down when we did, but it didn't really cost us. You know, it's so easy to start and stop when you're working out of Timmins. The mobilization costs are pretty low. So we were actually under budget, and we'll be making our plans for getting back. Probably going to wait until after Johnson wraps up and then start drilling in the fall. We will have to get back because it was flow through money that was raised for that, but and then spend more time teeing up some of the surface stuff this summer. But you never know. There's a chance we could get back there sooner than that.
And there's 3 projects there, and they're all different beasts. I mean, the Monroe Crucis project has some fantastic splashy high grade numbers that have come out of it. The other 2 have slightly different concepts driving them.
Yeah, that's right. So, you know, Croesus is it's a really neat corner of the belt that's been kind of underexplored in my opinion. It's sandwiched between a few other deposits, and it's, you know, it's got some splash. It's never had that much modern systematic exploration work outside of the immediate core of the Croesus itself. And it is, you know, it's a real cornerstone for us in Timmins. The other projects are bigger, sort of more greenfields type plays. I mean, they're greenfields exploration in a brownfield district, though, with good conceptual geology. So higher risk, but I think some of the better reward comes out of stepping out into some of these areas that have been lesser tested. You know, Great Bear might be an example of that. There's other good examples of that.
Gotcha. Okay, and then I had one question we'll just bring it back to Johnson Tract for a final question here that I think maybe will tie things up. Someone was asking how far off might a PEA be, and I think I'm guessing that your answer will probably capture the corporate outlook for the opportunity here.
Yeah, you know, I mean, I think it's substantial enough you could consider looking at the economics, but it's much like the question of when you're drilling a new discovery, when do you put a resource on it? Because there's a certain segment of the market that then kind of caps that and says, well, there's no more upside from that. So for us right now, a PEA is not at all in our sights. We can come back to that after we've got some more drilling done. But when we acquired this, our full focus was on, we see so much exploration upside here that this is really just the starting point for us. Admittedly, it's put the starting line way down the track, but that's what it is. That's a starting point. So we have no intent on doing a PEA right now, and wait and see what we can grow this into before you start framing some economics on it.
Sounds good. Okay, so let's just, I mean, you say the next thing that will come out for HighGold is certainly results from Ontario. All you'll say about that is soon?
Yeah, fairly soon.
I can try.
Yeah, and then we'll formally announce our plans for getting out in the field. It's going to be up upon us here pretty quick, so we're pretty excited to get back out.
Absolutely, it's already the beginning of May, so companies will be up drilling northern projects before we know it. Thanks everyone for your time and attention this morning. Thanks Darwin for taking us through the HighGold story. Obviously an exciting, I like it. It's an exciting development story or developing story that I think has the potential to generate just as much excitement this year as it did last year, because now you're looking at new stuff. So yeah, thanks Darwin. Thanks everyone for listening. Great. And everybody thanks, have a good week. Obviously, if you have any questions for myself or for HighGold, please reach out. We're all willing to answer any questions that you might have. And happy Monday.
Thanks, Gwen.